Good morning, traders. I'm Dan Pavlonis, Senior Market Strategist here at RJO Futures. Today I'm here to talk about currencies, as I do every week. We had GDP this morning, softer than expected, but still showed growth. Overall, we've been seeing this uptrend of growth here in the U.S. It's obviously given the Fed some aptitude to taper a little bit more. And on the trend that the Fed is tapering, we're starting to see a little bit of fluctuation in currencies like the euro and the dollar, and even some currencies connected to that towards commodity-based currencies like the Australian dollar. Because of what we're seeing, GDP growing, it's a sign that we're producing more here in the U.S. And jobless claims this morning that came out showed that there's less people signing up for jobless benefits. I think that shows a clearer picture that we are starting to go in the right direction. If we look back a couple of months ago, we had the polar vortex and all that stuff that slowed down economic data. But now we're starting to see a basis of growth here. We're not seeing great growth, but we're starting to see, or we're continuing to see an uptrend. That's here in the U.S. We're seeing other things that are dissolving, or economic data that's dissolving in countries like China, for instance. We're starting to see a credit crisis similar to what we saw in 2007. It could evolve into something far greater than that. We're starting to see, companies go down. We're also seeing a form of quantitative easing over there that's about 3 times the size of the U.S. and about double the size of the U.S. and the European Union's quantitative easing. So they're being accommodative over there in the face of credit defaults. We're going over to Eurozone now. We move over there. We're looking at deflation. I mean, Mario Draghi's target of 2% is not even close to where they are right now. We're seeing a high euro, and at the basis of that, we need to see a lower euro value to see any kind of inflation. And remember, they need inflation because they need tax revenue. If how else are they going to be able to get out of this debt? It's like this silent tax or invisible tax, but in order to keep the status quo, they're going to need to reduce debt and reverse the uptrend in the euro. I think what we're going to see is government intervention over there over the long term. It's not going to be just one hit. It's going to be several things that they do over the long term that's going to devalue the currency. We're also going to see more value coming into the U.S. currency because we are starting to see some forms of inflation. We're starting to see food inflation up 19%. It was read yesterday, information came out about that. Gas prices, crude oil still stabilized right around $100. We see, oil over $100 today. All these things are done on purpose. We're starting to see fluctuations in the market, in equilibrium in markets like crude oil at $100 because the cost of producing crude oil is right about there. The revenues that are created off of that to cover cost and government debt is right around there. Long term, what we're seeing is, and I think we're going to see more of this, is strength in the dollar. The purchasing power of the dollar, I think, is going to go up long term. We're going to be able to purchase more overseas, and we're seeing a little bit of strength in the dollar today. We've seen it bottom out over the last couple of weeks, but this thing's not going to go straight up. It's been in this steady uptrend since 2008. It hasn't broken down and made new lows. It came down close to testing the lows, but again, the uptrend is intact. None of this stuff is going to happen overnight, but that's what I perceive to happen. And if you have any questions about that, feel free. Give me a call. Dan Pavlonis, Senior Broker, Senior Market Strategist here at RJO Futures. My number is right there. Thanks. Futures and options on futures may involve substantial risk and may not be suitable for all investors.